Evan chooses a 401k. Lena chooses a Roth IRA. They both start at 30. They both make $70,000 a year. They both invest for 30 straight years. Same city, same tax bracket, same goal. Retire comfortable, independent, and free from financial stress. But 30 years later, their plans tell two very different stories. Evan signs up for his company 401k. His employer offers a 4% match. That's $2,800 of free money each year. He contributes 10% of his salary, $7,000 annually. Together, $9,800 goes into his 401k every year, all before taxes. It feels great. He's saving for the future while keeping a slightly bigger paycheck today. Evan's tax bill drops because those contributions reduce his taxable income right now. He feels like he's winning. At work, everyone tells him the 401k is the smartest way to retire. It's easy, automatic, and looks impressive when the balance grows. Lena takes a different route. No company match, no payroll deduction magic. She opens a Roth IRA. Every year, she contributes the maximum $7,500, money that's already been taxed. Her paycheck takes more of a hit today, but every single future withdrawal will be tax-free. No surprises, no taxes later. Every dollar she sees in her account is truly hers. While her friends chase deductions, she's buying peace of mind. After 5 years, Evan's 401k sits around $63,000. Lena's Roth holds about $51,000. On paper, Evan's ahead by $12,000. He's boosted by the match, the tax deferral, and the higher contribution total. His balance looks like it's climbing faster, but every single dollar inside his account will eventually be taxed as regular income. No statement shows what part of that money really belongs to the IRS. Lena's Roth looks smaller. She gets no match, no immediate tax break, but her entire balance belongs to her. No future tax receipt waiting in the mail. She's paying the IRS today, so she never has to again. Fast forward to year 10, Evan's account grows to around $132,000. Lena's reaches $108,000. Still, Evan's balance looks better, but when you factor in taxes, things tighten fast. If Evan's future tax rate stays near 22%, roughly $29,000 of that balance belongs to Uncle Sam. His real after-tax value? About $103,000. Lena's $108,000, all hers. By year 20, the pattern continues. Evan's account grows to around $360,000. Lena's reaches $295,000. At first glance, a clear gap. But Evan doesn't really own everything showing on that screen. After subtracting future taxes, his true spendable amount shrinks to around $281,000. Lena's remains $295,000, tax-free, clean, untouchable. Now they're nearly even without her ever getting an employer match. Her long-term bet on tax-free growth starts to pay off. At age 60, Evan's 401k tops roughly $810,000. Lena's Roth IRA sits just shy of $640,000. Evan's proud. He crossed the 7-figure finish line when adding his company match. Lena's numbers look smaller, but hers have no fine print. Evan begins withdrawals, $55,000 per year to cover living expenses. Since 401k withdrawals are taxed as ordinary income, he owes around $6,000 in federal taxes every single year. Lena withdraws the same $55,000 and keeps every penny. No taxes, no forms, no surprises. If they both live 25 years in retirement, Evan will pay at least $150,000 in total taxes from withdrawals alone. Lena pays zero. Every year, his account feels a little lighter while hers stays fully hers. His retirement statement may look bigger, but her money stretches further. At age 73, Evan runs into something he can't control: required minimum distributions, or RMDs. The IRS now demands that he withdraw a portion of his 401k each year, whether he needs the money or not. If his balance is now $1.5 million, his first mandatory withdrawal is just over $56,000, taxed as income. Every year, those withdrawals could push him into a higher tax bracket and make his Social Security benefits more taxable. He loses flexibility just when he wants simplicity. He doesn't decide when to take money, the government does. Lena doesn't face that rule. She can leave her Roth IRA untouched for her entire lifetime. If she doesn't need the cash, it stays invested, compounding tax-free for as long as she lives. And when she passes, her heirs inherit it tax-free too. It becomes one of the cleanest assets to pass down. No tax surprises, no headaches. At age 50, both face a surprise, a $25,000 emergency. Evan taps into his 401k. Because he's under 59 and a half, that withdrawal triggers a 10% penalty plus income tax. He loses close to $7,000 right away. He walks away with just $18,000 of the $25,000 he needed. That's the price of touching pre-tax money too soon. Lena withdraws $25,000 of her original Roth IRA contributions. No penalties, no taxes. Because her contributions were made with after-tax dollars, her account's earnings keep growing untouched. She gets her full $25,000 when she needs it most. That flexibility becomes something few retirement accounts can offer, true freedom to handle life without punishment. By the time they reach their mid-80s, the math is clear. Evan's retirement income from his 401k worked, but the taxes never stopped. Between required withdrawals, Social Security taxation, and federal taxes on his income, he's given back nearly $200,000. Lena kept hers. Her Roth IRA gave her control and confidence. Evan's 401k gave him growth, with strings attached. And when inflation crept in, those taxable withdrawals felt heavier than ever. The truth is, neither account is wrong. The 401k wins on volume and the employer match. The Roth IRA wins on flexibility, control, and tax freedom. But choosing one without understanding both can cost more than people realize. You can't compare them by balance alone. You compare by ownership, control, and what you actually keep. The smartest move isn't choosing between them, it's using both. Contribute enough to your 401k to get every dollar of the employer match. That match is free money, a guaranteed return on day one. Then max out your Roth IRA. That's your tax-free growth bucket, the one that buys you control later. If you still have more to invest, go back and add extra to your 401k. The higher limit shelters more income while you're in your peak earning years. This order blends the best of both worlds, the power of the match and the freedom of the Roth. It captures today's tax advantage while protecting your future self from unpredictable tax rates. When taxes rise, and they often do, the Roth IRA becomes even more valuable. Evan's statement will always show bigger numbers because nobody prints the IRS's cut underneath. Lena's account looks smaller, quieter, boring even. But if you count what they actually keep, Lena wins where it matters, spendable, tax-free income for life. That difference, invisible on paper but huge in reality, changes everything about retirement. So the question isn't which plan is better, it's this: do you want to look rich on paper or be free in reality? Because the 401k defers your taxes, the Roth IRA eliminates them. And when retirement comes, one of those choices lets you keep every dollar you worked for. The best strategy is balance. Take the match, build the Roth, and plan for both sides of the tax equation. Your future freedom depends on the taxes you choose to pay today. A big number doesn't always mean security, but a tax-free one? That's peace of mind you can count on. Your plan doesn't have to be flashy, it just has to include everything. This is Net Plus, where money stops being a mystery and becomes a language you finally understand.